Welcome to today's webinar, where I'm delighted to be joined by Nick Jones, Head of Specialist Distribution from Together. And today we're talking a little bit about embracing change, about what specialist finance means, how it can help, and why it's an essential part of today's mortgage advisor's armoury. So firstly, who are Crystal Specialist Finance? We are a specialist distributor. We have over 80 lenders on panel across our 6 business sectors, exclusive and semi-exclusive products available. We are dedicated to the intermediary, so we have ongoing training, BDM visits, case management, handling, etc. And everything we do is focused around helping you to complete more business. We are multi-award winning, we're still family owned. There's a number of awards that you can see there, 3 SFI awards this year, for example, a BNC award for Best Specialist Distributor as well. We're passionate about specialist finance. It's one of our key mantras within the office. You've placed your and your customers' trust in us, so it's up to us to make sure we deliver that. We believe in phone first, we believe in talking to you to provide updates. We don't just hide behind our technological systems. We know we're only as good as our last case, and we want you to send the next one. So it's up to us to support you throughout the life of that case and beyond. We don't stop when an offer is issued, we see that right the way through to completion and then beyond. Service means that we can find unique solutions for your customers, and our relationships mean that we've got lenders that no one else has. We can get deals done that other people may struggle with. We work quickly. We aim to get back to you and complete your case in as short a time as possible. We know time is money. We want to get that case funded. We provide you with updates on market trends. We provide webinars such as this one. We provide marketing material, podcasts, any kind of training event that we can do to ensure that you're one step ahead, that you know what's happening both in the market, in regards to regulation, and also from lenders and products. Specialist finance can appear daunting. We do it every day. We do more specialists than we do anything else. For us, it's our bread and butter. So therefore, it's up to us to assist you with your current case, but also then show you the opportunities and show you where you can find new ones from. Any fees charged will be discussed and agreed up front. We don't believe in hiding things or having any hidden surprises for your client at the end. And again, we're all human, so we know occasionally cases will hit problems. You could have a down valuation, there could be some credit, there could be an urgent timescale that's not been adhered to. So we proactively take action to resolve these issues. We'll provide alternative lenders where we have to, or unfortunately, if it's something we can't help with, then it's vital we come back to you as soon as possible, rather than dragging the case out and then eventually saying, oh, by the way, we can't assist. We're investing heavily in technology to make sure that whatever we do can be the most efficient and streamlined way possible, that we can give you the very best customer journey. And expertise, our people have more than 200 years experience in the industry. We don't do anything else. We know where our strengths are and we can deliver those for you. We're also very proud to be part of the Together Plus club. So this means we have our own dedicated team of underwriters at Together, and we can offer all of their product range from first and second charges, consumer buy-to-lets, through to commercial and bridging. What that means is that we work with very highly skilled underwriters, with an underwriting team leader, very closely with other senior members of the team at Together, and we're trained regularly on what they will do and how their processes work. So therefore, we can get solutions to complicated cases, we can fast track your applications, and we have exclusive products available, which we'll come on to in just a second. So specialist finance for us, as I mentioned earlier, is our bread and butter. So we understand how it works. We've done it long enough. We've seen the vast majority of scenarios before. So for us, it's about explaining the process, timescales, and what's required from both you and your client in order to get that deal completed as quickly as possible. You very commonly hear people say banks aren't lending, or this lender isn't interested in lending. The market is huge at the moment. Bridging, for example, there are more lenders than I can ever remember sitting in the bridging space. So it's all about knowing which lender is the one to go to. And that's not just based on price, that's based on appetite, that's based on requirements, deadlines, the various nuances that apply to your customer. It's all about finding that right home for that client to get that case done quickly and efficiently. So for us, normal for us includes adverse credit or a low credit score, tight completion deadlines, overseas borrowers, unusual properties, and the other bits and pieces you can see on there. And it wouldn't be right unless we touched on Brexit, the elephant in the room in a lot of these conversations where it's not mentioned. We don't have a crystal ball, so none of us know what's going to happen come the 31st of October. And there's a lot of uncertainty around. People don't know what to plan for, don't know what impact that will have. And obviously that has a negative impact on markets. House prices, daily at the moment there seems to be stories coming out saying house prices are stagnant, that property sales are falling. Again, is it the right time to sell? Is it the right time to buy? Who knows? And of course, there could be issues there with lender liquidity. Most of us can remember back to the dark days of 2007, 8, 9. Lenders seemed to be dropping out of the market. A lot of that was based on funding from other areas. So if investors feel that the UK property market is poor, will that impact on the liquidity available out there in the market? Then of course you've got the opportunities. You've got the strength of the pound. It's a great opportunity for foreign investors to buy in the UK. People still need somewhere to live, so people will be renting, people will be buying. It's just whether those transactions actually make sense. So taking the opportunities out of that, a reduction in house prices obviously means increased access to the market, which can provide opportunities there for bridging new residential and buy-to-let customers, or even commercial. So we're seeing at the moment a number of developers, for example, buy commercial stock, do a refurb on that and convert it into residential, which can then either be sold on or added to their investment portfolio. And for customers who don't think that sale or purchase is the right way, the right move, many of them want to improve, which opens up opportunities therefore in second charge lending, bridging finance, and across the refurb and development range. Bridging finance, again, if your client's looking to do refurb work, needs to sell their existing property to buy a new one, then bridging finance is an excellent option. Terms on bridging are now going up to, it used to be under 12 months, was the rule everywhere. It now can stretch up to 36 months in some circumstances. So it's certainly an option available for you to have a look at for your clients. From a second charge point of view, if your client needs additional money and you're looking at a remortgage, remember your MCD responsibilities. It's worth considering a second charge. Rates are now mid-threes on seconds. LTVs, obviously rates go up, but LTVs can go up to 95%, maybe even higher in certain circumstances. So it's certainly a good option for your client, especially if you've got an early redemption charge or something like that on a product. Jumping back to bridging for a second, the market continues to grow. So at the end of quarter two, 4.62 billion, which is a 14% increase on quarter one. In the preceding 12 months to the end of quarter two, applications were at 22 billion, the 9.7 increase on the same period in the previous year. And that's information there from the ASTL. The bridging market is in a very good position. There's a lot of competition out there. Standards have improved dramatically over the last few years. Many of these lenders are now FCA authorised. Many of them that aren't authorised follow the same practices as those that are, but lend on different property types. So obviously FCA authorisation only applies to residential properties. If a lender's doing a buy-to-let transaction, a lot of them follow the same processes. Transparency is improved, which means the offers are now much more detailed than they were before. There's no more of this hidden charges, there's no covering a document and sign here kind of thing, that practices that people would have associated with dodgy lending back in the day. So it's certainly a product that we believe in. It's certainly a product that offers excellent solutions for a wide number of clients. The 2018 survey there from MT Finance showed that 51% of cases that they looked at could be classed as typical, and 49% could be classed as complex. So within that complex section, they've broken down a little bit more of what those sectors are. So adverse credit, self-employed, maybe the age of the customer, expat or foreign nationals, complex income, debt consolidation, and then various other factors that fit in there. So even if you don't consider yourself a specialist mortgage broker, you'll have dealt with a self-employed client, you'll have dealt with a client with some adverse credit, you'll have dealt with a client that's either borrowing into or getting close to their retirement age. So all of these things fit well within the remit of specialist finance. So customers today have more diverse needs. I know Nick will touch on this a little bit more later on. So if you're not considering specialist finance as a major part of your arsenal, then you really could be missing out on assisting a number of clients. So your high street lender typically doesn't assist clients with adverse credit or with CCJs, defaults, bankruptcy, where complex income situations exist, maybe a self-employed client or a client on contract, a client lacking relevant experience, expats, foreign nationals, or clients borrowing close or into their retirement age, so the later life borrowing piece. So with a little help from Crystal, we can help you with all of these types of clients. We can bring specialist finance back into your remit and help you write more business and assist more customers. So looking at a couple of case studies where we've worked really closely with together to obtain some very interesting solutions for clients. So with this particular one, Food Group, 9 directors of the company secured a £1 million funding package for their business, and due to lack of equity in the commercial premises, it was second charge loans secured across their homes. So they needed to clear an existing bridge and put some money back in the business. So we sourced Together's homeowner business loan for the directors of the business, allowing them to borrow against their residential property, put it into the business. So this deal was a little bit complicated because obviously the number of borrowers, the asset that we're securing against isn't the commercial property, and there were various different personal circumstances for the directors involved as well. So we grouped this into 2 linked cases to make sure we could get the very best possible rate for them, and the entire process, including consent, documentation, valuations, etc., legals, etc., took under 6 weeks. An excellent solution for the clients. Monaco-based businessman approached his broker looking to clear an existing £5 million bridge and then 400k to do a refurbishment on the flat as well. And this would see the property's value raised up from 10 mil up to 12.5. The client was an expat. The asset was owned by an offshore limited company we worked with together, got this approved within 15 days, having received an offshore legal opinion to ensure everything was above board and straightforward. So really nice transaction, although on the face of it looks a little bit complicated. Another example of how the homeowner business loan is an excellent solution for some of your business clients. Customers were looking for £1 million for their ice cream business to be able to purchase some additional machinery. Problem here was equity. They initially were looking for an unsecured loan or a loan secured on the asset itself. However, they'd been declined by the main lenders that would provide this solution for them. 10 shareholders, all of whom could act as guarantor, all owned their own home. However, their wives were not happy to guarantee that. So we sourced the homeowner business loan, secured across 8 of the properties without the wives needing to be involved, done at 5.99, so much cheaper than a lot of the unsecured borrowing options. The clients could have this on an interest-only basis for 10 years as well to keep costs down even more, pending sale of the asset or sale of the business. Even more complicated here was a little bit of mild adverse for one of the shareholders. However, by restructuring the deal, we could make that work and get that through still at that very low rate. So Together Plus means we get access to enhanced products. So first charge packager exclusive for us. This is on a residential mortgage, up to 75% LTV, loans from 25 to $1 million, no minimum income requirement, up to 40 years, rates from 5.49% on a 2-year fixed for no credit issues within the last 12 months. But again, as you can see there, the range of customers that this product is aimed at is huge. So 0 contracts, retired, benefits, lending into retirement, etc., all acceptable on this product. The Prime Plus, so for this one, 4.99 on a 5-year fixed. They will look at first-time buyers. Again, we can do 75%. We can look at, again, a wide range of employment types. We can look at first-time buyers. We can go into retirement and ages of 18 up to 80 at the end of the term. So again, another great product there on the 5-year fixed basis. On a buy-to-let, so standard buy-to-let 5.99, which can include portfolios, and specialist, which looks at your HMOs, holiday let, semi-commercial, etc., from 6.97. So on this one, we can again consider expats. We can look at clients without permanent right to reside. There's no maximum limit on the number or value of properties within that. And there's no maximum age where the rental income meets or exceeds the required interest coverage ratio. We can always use top slicing with this as well, where we can use background income if the income stress test is a little bit tight. So again, that offers a lot of good solutions there as well. And then a secured loan exclusive up to 77.5% LTV, rates from 5.34 with no ERCs. Interest only is available, loans from 3,000 upwards. And clients with less than 12 months mortgage history accepted, lending into retirement accepted, and again, that's still that whole range of flexibility around income and an adverse credit there as well. On the bridging side of things, rates start from 0.49 for Together Plus bridging, loans from 26k up to 10 million, flexible terms, cross-chargings possible across multiple asset types. LTVs can go up to 80% on a non-regulated transaction or 70% on a regulated transaction. The key thing with bridging is its flexibility. So the good thing with bridging, especially Together, is there's a rate card and then you can discuss it. So most specialist cases are unusual in one way or another. So please pick up the phone, speak to us and let us get something worked out for you on that basis. Consumer buy-to-let from 6.97 on a 2 and 3 year fixed basis. Again, all the flexibility that you're looking at there as well. And then on the commercial, rates from 6.99, again, can consider expats. And the same flexibility you'd expect from Together is available on this range. So when you're considering some of the near prime rates from lenders are in the 5s and 6s and above, this isn't a bad product at all. So, how does it work? Key for us is, as we touched on earlier, speed, service, flexibility. So contact us any way that's easier for you. Email, portal, telephone, visit, see a set number of events. Whichever is easier for you will do. Speak to one of our new business team. Let's discuss the deal. Let's see what you're looking for. Let's get warts and all. Let's understand the problem so they don't come out of the woodwork later on. And let's find a solution that can assist. So then we'll issue some terms for you. Generally the most competitive and most relevant terms available for your circumstances. If you're happy with that, once you've spoken to your client, complete the application form, pop that back in. We then do the searches, we set everything up, we handle that whole transaction then right the way through to offer. Once the offer's signed, legals are instructed, we even then work with the solicitors in order to get all those little bumps and hurdles ironed out at the end and get the case to fund successfully. And there's never been a better time to look at specialist finance. Not to steal too much of Nick's thunder, markets are changing, clients are changing, products are changing, property types that clients are looking at are changing, lenders' processes changing. Not to mention regulation, tax changes and everything like that. It's all thrown in there to keep us busy. So by all means, pick up the phone, discuss any of your requirements with us, and let's see if we can find a solution for your clients. So thank you for listening to me. It gives me great pleasure now to hand over to Nick, who'll talk you through the Together offering. Thanks, Nick.
Thanks, Chris, and welcome to the Together presentation on residential mortgages. Losing clients you will be the new normal. It's quite a bold statement, and I know that's something that is challenging the marketplace at this moment in time, and the way that lifestyles are changing. What we're going to look to go through over the next few moments, we're going to have a look at some of the headlines in the mortgage market. We'll have a look at the changing world. We'll have a look at some macro trends. We'll have a look at some IMLA feedback that we got that was published very recently, which we looked into and did some YouGov surveys around that, and some of the findings of that YouGov survey as well, with some of the clients that are falling out of the mortgage market, and also what we can maybe do to help these customers get back into that mortgage market. So here's some of the headlines that we hear from some of the mortgage market. Lifestyles are changing and clients are being alienated by restrictions in low price and high street lending criteria. The gap between advising on high street products, specialist products, isn't noticeably closing. That size of the high street lending market versus the specialist isn't noticeably closing, even though clients and customers are actually changing their habits. Clients are feeling underserved by both lenders and brokers and are starting to vote with their feet. That references some of the IMLA data and the YouGov survey that we looked at, and some of the interesting stats that have come out of that. And some clients are starting to move away from the actual traditional mortgage process and looking to fund their purchases in different ways as well. But there is some good news on the horizon. There are ways in which we can all solve this conundrum, and hopefully we can learn some more of this as we move forward. The world is forever changing. I don't think there's any surprise in this statement. In fact, it was Herculitus that said the only constant in life is change. And that is very true today. People will always change the way they obtain their information. But one thing that doesn't change is behaviour. But there are now more choices, options and ways to assess different decisions. And this is something that as a business you'll have to do to constantly stay ahead of the game. It's not the strongest that survives, it's the one that adapts to change the most. But how and what are these changes happening will change the way mortgage customers will be marketed to, advised to and ultimately lent to in the future, understanding the upcoming change in things like macro global trends and where the future is and always will be. The consumer market is becoming progressively less tolerant of complexity. Although consumers tend to buy products which are ever rich in features, they often prefer those that are simple and intuitive. Different changes in the way that macro trends are looking at the households and the changes within that. Things like later life formation and the expensive costs of adulthood stem from persistent unemployment in some markets, as well as the rising property cost and education costs. These costs have created a new life stage, extended adolescence. People in this stage have fewer current responsibilities but high future needs in financial services as well. Technology is facilitating more customised shopping experiences and putting greater power in the hands of consumers. Consumers have unprecedented access to information via the internet. They need to make more informed decisions about switching between brands. I think that some of the confidence in the traditional institutions, following bank failures, government collapses and corruption, etc., have given a bit of unrest, and previously accepted norms such as local communities and nuclear families have sent consumers searching for new brands, values, and almost all organisations. So if you look at some of the brands that have disappeared away from the high street, the likes of Toys R Us and Blockbuster and different businesses like that, people haven't changed buying products or toys or anything. What they've done is they've changed the way that they've done that. You've got to have a look at what you're doing in the future. And this will bring us on to some global trends. So macro global trends affect how we all live our lives, and being ahead of this and being mindful of this and how you can incorporate this into your business and how the world is changing will ultimately change the way that high street lending is also changing as well. Macro trends are directional shifts that involve large populations and last 5 to 10 years or more. Some examples might be the ageing population, of the development of global connectedness through social media and advances of technology, etc., and the Internet of Things. If you take the first column there, the middle classes, by 2030 the global middle class will double in size to £4.9 billion. Asia will hold 64% of the global middle classes, will account for 40% of the global middle class consumption. And Europe and America middle classes will shrink from 50 to 22% of the world population as well. As people's wealth shifts, their demands shift as well. And what we're looking at is different trends on people's income and their expectancies around where they want to live, how long they want to live there, how they want to borrow money, and where they're going to borrow money. If you look at urbanisation, the central column there, by 2030, 67% of the population will live in cities. By 1970, the average new build house had 3 bedrooms. In 2015, it was 2 bedrooms. So how is the modern day builders and also lenders looking at part of the urbanisation of people moving out of the country, moving back to the cities, as demands on utilities such as broadband and hospital and schooling? This is where the facilities are really helping consumers, where they're looking to move back to urbanisation. As part of that, the space and the cost, the only place you can sort of look to build property is moving up as the urbanisation starts to become congested. Europe has the highest rate of unmarried cohabiting family groups. It's a very interesting stat as well, and certainly as more and more families come together in later life with more and more children, the size of the property and the types of property these people are going to be living in may not be catered for as well. And finally, we move to, in the end column there, the over 65s. The over 65s will outnumber children under 5 by 21% of the world population as well. The over 60s will be the fastest growing consumer for the rest of this century. And those that over 50 will hold 80% of the UK's wealth. So how will high street lending and how will lenders become more embracing of these trends and the changes in both the borrowing customer, the age of the customer, the types of property that we're lending against, and also the demands of the types of property that these people want to live in as well. So bearing in mind all of the macro trends and the ever-changing world, what we have now here is some cold hard stats around consumers entering the mortgage market or entering the mortgage process, should I say. IMLA conducted a survey and found out that 61% of all mortgage applications made in the UK did not progress through to funding, which is a very surprising statistic, which is both worrying, but also there's a huge opportunity as well. Together commissioned YouGov to research the 61% of the consumers to look further into the reasons why they didn't proceed. And the results were very interesting around how consumers were being looked at by some of the high street lending. And what we've got on the next slide is some of the results from that as well. So we commissioned some research to find out why 61% of the country were actually being declined as part of the mortgage process, and this is a breakdown of the reasons why the consumers were rejected as part of that process. And the first one that we've got there is low credit risk and lack of history. So you've got consumers there who are looking to borrow money, but because either they've got a low credit score or because they haven't had a big enough history of score, that's the reason why they've been turned down. Now, credit score, traditional banks and building societies still using credit scores, still looking for the ideal customer. looking for the perfect customer. 6 years is a long time in the current world without having a credit blip. Giving life is changing all the time. The recession, the threats of redundancy, divorce, CCJs, defaults are on the increase, and more of these are being registered now for even minor offences such as car parking and mobile phones, etc. This doesn't necessarily mean the client isn't credit worthy. It just means that they've had a credit blip along the way. The next one here, the next three that you'll see highlighted, didn't earn enough to make the repayments, too much debt or not enough credit applications. So there's that real sweet spot between having too much debt and not having enough debt. And employment type. Now this is a really interesting one around a sort of employment type. 41% of these customers have been declined rejected, due to affordability. And none are due to affordability issues, the ever-increasing cost of living in line with inflation. This 16% didn't earn enough according to the banks that were rejected. None of them were given the opportunity to discuss with that lender and have that sort of sensible conversation or have a common sense approach to it. Having a look at income and affordability in the last 12 months shows a position where if the customer has income and affordability and doesn't have any blips in the last 12 months, then anything could have happened in history. It's about understanding those customers and moving forward. So having conversations and really understanding a client's position in an individual basis through an income and expenditure is a more flexible way of looking at a client's current affordability situation. Anything can happen before, and certainly anything can happen after. But ultimately what you're looking at is that particular customer at that moment in time. Property type is the bottom one. 10% of customers were declined because of property. Property type is no indication if a client is creditworthy or not. Lending on all property types is about understanding the property types and tailoring your lending against them. Property is still a valuable commodity in this country. The last time I looked, we're still an island and we're not making any more space. But property types and the way that people are living at this moment in time is different as well. Just because somebody wants to live in a property which may be above the fourth floor in an apartment, or it might be a new build property, or it may be a different construction. It may be not your traditional brick and slate roof. It may be different types of property. But ultimately, lending to somebody because of the type of property they want to live in doesn't give any type of credence to whether they will be able to make those repayment strategies to you as well. One of the areas which is quite interesting is obviously 9% of the people who got rejected didn't actually know why they were rejected as well. Jobs and incomes are changing. In 2008, the world completely changed, affecting income patterns and cash flows. And many of us are less secure in our work, and we've seen a boom in self-employment, including contracting and freelancing. In 2007, 3.3 million people were self-employed and looking contracting. In 2017, it's 4.8, and it's ever increasing. As more you've got things like the gig economy, and you've got people who are being or taking on more self-employed work and having 2 and 3 jobs as opposed to being the traditional self-employed or employed as well. Many people are considering self-employment through directorship of businesses, especially in the professional sector as well. And some businesses are rehiring existing staff on contractor basis and workforces being more flexible, all in response to pressures of uncertainty, more economic uncertainty as well, and strict rules around hiring and firing. There's a big boom in zero-hour contracts, especially among long-term employees, as employers seek more flexible workforce as well. So all of these things taken into consideration, it's very difficult to set a very high street objective where you're just looking at a credit score and underwriting towards that. I think as the world is ever changing, what you're looking for is more flexible underwriting criteria, more understanding the customer, and more common sense approaches to it. So from that further research, we looked further into the types of customers that were behind these stats as well. And what we've got here is types of demographics of customers around some of the reasons why they were rejected as well. And there's some highlights across the top there, but obviously there's a lot of information on there. I won't go through all of them entirely. But 54% of the mortgage applicants rejected for reasons part of the new normal. So 54% of the people that were rejected, we would class as part of our new normal process, and having a look at the types of customers. 12% of rejected mortgage applications were turned down for employment choices, and that's an interesting word, choices. I wish there were all lots of choices for employment, but ultimately people are looking to work and they're looking to earn money in different ways. So you've got customers who may have they may have their current role, but they have a second job, or they've set up their own business part-time, where they're looking to bolster their existing income with other second and third jobs as well. There are things where you've got customers who are they have their primary job, but they're looking to develop a new business from that as well. So there's lots of different ways that people are looking to earn, and it's all these types of incomes that customers they're looking to take more control of their own income and their own earnings, and becoming more self-employed as well. 12% of rejected applicants have an employment or income type that's not suitable, or 3% has insufficient employment history as well. So having a look at how long someone's been employed, and having a look at the type of income that they've got is very pivotal to actually making sure that affordability fits as well. 10% of rejected applicants wanted a mortgage a property lender would not accept. So having a look at the types of property that the customer wants to live in, and whether that be in an urban area or out in the rural area, or whatever the construction of that property might be, the lender's appetite for that type of property is dictated whether that customer can continue or not. 66% of millennials turned down their mortgage for their lifestyle choices. So looking at the way that people are earning, particularly younger people coming through as well, having more than one role, or having side roles, or having an employed job and a self-employed role as well. The lifestyle that they make, they may want to work more flexible hours on shorter-term contracts. They may want to work abroad for a while as well and move back. All of these lifestyle choices that people are making is affecting whether they will be or won't be lent to by the high street. And this is what we're talking around in that specialist lending marketplace. There is more flexibility around that. 19% of millennials are rejected for having too much debt or too many mortgage applications, compared to just 8% of over 55s. So the more that someone applies for credit and gets declined, that obviously starts to affect their score. That doesn't affect their ability to maintain affordability, or to their credit worthiness, should we say, as well. But the big one for me is the big red circle in the top right hand corner. 27% of rejected mortgage applicants are put off ever applying again. That's a huge percentage of people. Now, there is no stats say that they didn't actually come back into the process, but ultimately they were put off by applying ever again. It doesn't say that they won't, but it certainly says they were put off by that as well. 23% of rejected applicants are unsure or don't know what to do next as well. So whether they've gone direct to a lender that's been declined, or whether they have gone back to a broker and unsure what to do next, but they weren't sure what to do next. And again, this is where the support of the intermediary market, making sure that their education is done, can certainly help that go through. 13% of applicants pull out of the process because it was too complicated, and 7% said there were too many stages as well. So trying to simplify that process and make sure it's a little bit slicker with technology and transformation will certainly make that go through a lot smoother as well. And only 17% say that they will reapply after once their finances fit the relevant criteria. So there is still a large percentage of people who may not apply after it's gone out as well. So people are falling out of this process. So I suppose it's what we can do to actually do that. But the good news is that Together and the specialist lending market would have considered lending to 66% of these respondents. The reasons for these rejections and the types of reasons that these customers weren't allowed to go through the mortgage process were part of what we call the lending of the new normal. So what can we all do? I suppose from our point of view, it's getting to know some of the specialist lenders. And if you see one BDM, make sure it's a specialist one. You know what the high streets offer, you know what they can do. So getting to understand a little bit more about what the specialist lending market can offer, whether that's direct through a lot of the lending space or using some of our specialist distribution partners like Crystal. Review the process within your organisation to allow room to do this. In-house or create enhanced partnerships with specialist distributors like Crystal, who have the experience, they have the knowledge, they have the understanding, and they have that understanding of what the lender's looking for and can understand what they need to process the application through to submission, and ensure that the process is both slick and quick as well. And if we do nothing else, I suppose at your next sales gathering within your own business, have a look at these stats and talk about them and see what opportunities else are out there as well, and see what you can do to address them, to aid more customers, say yes to more customers, convert more applications as well, because there is a world of specialist finance out there, particularly in the mortgage market, that will be able to help a lot of customers who fall out of the high street lending. So thanks for logging in today and listening to the today's webinar. I hope you've got a little bit more understanding about the specialist market and how we can all help those customers, and get a bit more understanding around how things are changing and what we can do as mortgage advisors, as specialist distributors and lenders to work together to help more customers. Thanks very much again, and Kris, back to you.
That concludes today's webinar. Thank you all for tuning in and listening. And remember, if you do have any cases you'd like to discuss, please give the guys a call, 01827 301070, and we'll be more than happy to discuss your needs with you. Thank you.